The markets certainly a little bit unsettled, but ultimately don't do much of anything despite the weekend's harrowing political news flow out of the United States. This is Macro Money. I'm Ilya Spivak, head of global macro here at tastylive. And we're going to look at the set of outcomes that we were presented with last week, which seemed to mark a very important change in the way that financial markets respond to economic news flow and respond to the expectations for what the Fed is going to do next, which has been, of course, a major catalyst for markets really for the past 9 months at this point, and consider what the story is likely to bring ahead. Because we appear to be in the midst of some sort of a head change for global markets here, and it is surely not lost on other market participants that the reaction function here is changing. So the question that naturally presents itself, and we'll unpack why here as we go through, is after all of the prognosticating around we're going to get a recession eventually, these rate hikes will eventually bring the economy down, so on and so forth, are we finally there? Is it now finally time to become worried in earnest about the path of global economic growth? So why even have this conversation? Where does this kind of a concern arise? Well, take a look at the way that the markets performed last week. And of course, the first thing that immediately jumps out is a massive decline in yields. The 10-year yield down 2.2%, the 2-year yield down 3.3%. So if we look across the curve, for the second week in a row, another give or take 2.5 to 3% decline, another major level shift in interest rates downward. Why did we see this? Well, Jay Powell, the chair of the Federal Reserve, of course, sat down for 2 days of congressional testimony, semi-annual outing that he does was last week. First, he appeared in the Senate, then the House. The message was exactly the same on both days. And the reactive part of it, not surprisingly, was on the first day when the markets initially got what he was saying. And it was a potently dovish tone shift for the Fed chair. He'd been saying for months that the Fed is focused on inflation, looking at a generally benign economy as something that is giving the Fed more time to hold rates higher for longer to make sure inflation is going in the right direction, that is lower. And the tone that we got last week was pointedly suggesting that perhaps that is no longer the mindset. That now Powell was talking about, we don't want to over-tighten. We don't want to unduly hurt the labor market. We are increasingly confident that inflation is going our way. All of which seem to result in a significant upshift in Fed rate cut expectations and a shifting of those rate cut expectations into this year from last year. So not only did we get more rate cuts between this year and next year added into the forecast, but we also saw more easing come into the front end of the curve, hence the 2-year here falling more significantly than the 10-year. So a rate cut ostensibly became more immediate of a prospect. On Wednesday, the markets had what looked like a spirited recovery until on Thursday, weak CPI data seemed to endorse what Powell said. Gave the markets a sharp shock lower. And so we see here that unlike anything we've seen for the past 3 months, the markets got closer to a rate cut, more dovish rhetoric, underpinned by more dovish implications from economic data. And stocks not only didn't like it, the leader for the stock markets over the past 9 months rally, the NASDAQ, actually finished the week with a loss. And where we did find strength, the Russell, the small cap index, seemed to find those gains because regional banks did better, housing related issues did better, largely because interest rates were seen as likely to begin coming down sooner. The dollar wobbled a bit, although its losses were relatively contained. The euro up just 0.6%. The yen had a very potent rise. There's been a lot of speculation about perhaps it was amplified by intervention, but certainly the falling yields situation was helpful for the yen, as it tends to be. Gold a little bit higher. But it was really the strange response from stock markets that ought to have captured the imagination because, of course, this was a very important change in course. We can see here, even just ignoring everything back from, let's call it mid-April, although it would further reinforce this story, but even just the very near term. The latest leg in the move higher for the bellwether S&P 500 has come alongside a very potent build in Fed rate cut expectations. But as we see here over the past week, the index has stalled even as the outlook has become more dovish. We've shifted from about 130 basis points in easing expected last week now to 150. At this stage, the market has fully discounted 6 rate cuts over the course of this year and next. What's more, the outlook for this year, as we just mentioned, has become more dovish also. We can see here, after nearly 3 months of standstill around a consensus of 1 cut, now it looks like we are much more so leaning toward the possibility of 2 cuts from the Fed this year. They are, in fact, fully priced in. The market has discounted 53 basis points in easing this year, and another 100 basis points in easing next year. So it is very interesting against that backdrop that the market at this point is no longer able to rally in earnest, though that has been its main catalyst, let's say generously for 3 months, but actually going all the way back to where we started this rally, with the Fed essentially signaling, then making official in November, the November 1st, 2023 policy meeting, that the rate hike cycle is over and that easing is now on a countdown to begin. So, why is this? What could this mean, this head change in markets? Well, as we've posited last week, ahead of the CPI data and ahead of Powell's speech, it seems to be that as easing grows more imminent, its arrival becomes less and less of a supportive narrative. The markets are happy to speculate that there will be rate cuts in the future while economic growth holds up, which is a broadly supportive narrative. But once the easing is imminent, the implications are that the central bank now faces circumstances that are negative enough that it is beckoned into action. That at this point, because easing is just around the corner, speculation around eventual stimulus and the supportive nature of that speculation is giving way to worries about what would actually activate the easing, which is ostensibly some sort of a downturn or some sort of an intolerable developing trajectory for the path of economic growth. That is, recession fears. And it is with that lens that we are going to look at what comes next. On the U.S. calendar, the major release following a speech today from Fed Chair Powell, where he essentially reiterated what he said in testimony last week, is the U.S. retail sales report, where the expectation is that we're going to get a goose egg of an outcome on the monthly numbers. 0.0% rise is the forecast. That's a slight deterioration after a 0.1% increase in the prior month, and a redo of April's number, which was itself 0. What's interesting is that if we get anywhere near expectations, we're looking at the weakest quarter for U.S. retail activity since December of 2022, which would line up nicely with the ISM data that got released 2 weeks ago now, almost, that likewise told us that there was a shocking decline in vigor in the service sector, such that economic growth in June was the weakest it was since December 2022. Now, we've seen that U.S. economic data has increasingly tended to underperform relative to forecasts. Not surprisingly, here's mid-April. Here's where this move starts. That, of course, very neatly lines up with mid-April being here and this move occurring as this one does. So weaker data is more rate cuts, is happy stock markets until not. And the until not perhaps speaks to this dynamic finally starting to stoke recession fears. And with that in mind, to give the kind of change in dynamic that we're seeing from market-wide risk appetite. Not only would a U.S. downturn, whether we want to officially call it a recession or not, will be a question for NBER down the road. They're the ones that ultimately make the determination, the National Bureau of Economic Research. But some kind of an economic downturn is clearly now a source of worry. And if we get a soft number on this retail sales report, even softer than is already expected, then yes, easing might become even more imminent in the minds of investors, but that may not necessarily be good news for stocks or for cyclical assets more generally, like crude oil or copper. We're also going to get, outside of the U.S., a slew of economic data suggesting that a U.S. downturn is probably not good news, doubly so for the global economy, because there isn't an offset that's readily available to underpin global growth. Last week, we saw indications that China, the second largest economy in the world, remains firmly on the mat, and the GDP and economic activity numbers that we saw published over the weekend endorsed that perspective once again. Woefully disappointing numbers coming out of China over the weekend. GDP growth 4.7% against expectations of 5.1. In industrial production, a little bit warmer than expected at 5.3% versus 5 expected, but retail sales sharply weaker, 2% versus 3.3 expected. So the story in China is still very, very weak. The story in the Eurozone, likewise weak, as we'll see momentarily. Those growth indicators have turned south, all of which speaks to weakness for global demand as a whole, because, of course, 50% of global GDP relies on just three economies, the Eurozone, the US, and China, and the other 50% relies on economies that are vendors to the former three. Which brings us to Canada. If the US economy is starting to turn lower, one might certainly expect that the country who's exporting to the US 80% of everything it sends abroad is going to feel that loss of demand. And so, not surprisingly here, the story in Canada is an important lens, not only on what's going to happen in Canada itself, but what it says about U.S. demand. We're looking at CPI data front and center this week. The expectation is that we're going to hold at 2.9% at the headline, but that the core is going to slip back to 1.6%, echoing April's number, but a little bit of a downshift from the 1.8% that we got in the prior month. Leading PMI data suggests, though, that there's a significant loss of vigor in Canada's economy, such that the input inflation index from the S&P Global's latest survey here, sharply lower, in fact, slipping to the weakest in 3 years. And so the risk here might well be that this data surprises on the downside. If it does, that probably increases the urgency for the Bank of Canada to cut interest rates. That's probably negative news for the Canadian dollar, but it also would speak to a generalized weakness in demand in Canada, which might well echo a loss of vigor in the U.S., since, of course, Canada is inextricably tied to the U.S. business cycle. We're also going to get inflation data out of the UK. There, we're expecting to see that we remain at 2% for a second consecutive month, which is a 3-year low on inflation. Now, when we look at the makeup of this inflation that's remaining in the UK, we find that most of it, looking at May's data, at this point comes from discretionary spending categories. Recreation accounts for about 0.5%, and restaurants and hotels accounts for about 0.8% of the latest numbers. So if we were to look at where UK inflation would be if we just took those components out of the conversation, and to be fair, also took out the impact of fuel, which at this point is shaving down about 0.6% from inflation, we'd be left with an inflation rate of a mere 1.1%, taking the three outliers on the top side and the downside out of the story. And so with that in mind, we again are looking at a situation that is susceptible to weaker economic activity, which, of course, the latest PMI data reveals in spades. We can see here, this is the composite index on UK PMI, and we can see that this dip here over recent months is telling us UK economic activity is slowing. What's more, the City Economic Surprise Index from the UK has started to wobble and suggest that economic data outcomes are increasingly disappointing relative to forecasts. This is, again, seemingly indicative of slower global growth. And to the extent that this shows up in weaker inflation and perhaps surprises on the downside as these cyclically sensitive categories now holding up price growth start to give way, this is it right here. Here's restaurants and hotels. Here is recreation. The these little bits right here. If they start to give way, then the British pound might suffer because the Bank of England might be seen as likelier to ease further. At this point, about 2 rate cuts on the menu for them this year, but that could yet firm up. The pricing is about 47 basis points. It could make it all the way to 50 and then perhaps even open the door for a little bit more this year and next. But it might also feed those global growth concerns that feed into the overall risk-off narrative that might be in the offing here. Then finally, we're going to get a policy announcement from the ECB. The expectation here is that rates will remain at 3.75% after they were cut in June from 4%. The outlook now calling for essentially 2 cuts. We're very close to fully baking that in. We can see that we're down to below 3.5% by October. So 1 more cut is already in. And then by December, we're 3 basis points shy of baking in 1 more cut. So a cumulative 47 basis points in easing on the menu here as well. And so we look at this and say, well, if there's no change in policy, what's likely to be a catalyst here? And of course, it's the press conference with ECB President Christine Lagarde, who will no doubt at least have some conversation around the fact that economic data in the Eurozone has once again taken a turn for the worst. Here's the composite numbers out of the region, and we can see that economic growth in France, as of June, shrinking at a faster rate than expected. Obviously, as we've said a lot here on macro money, PMI numbers under 50 point to contraction, and the further they go under 50, the faster the contraction. Above 50 is growth, and the faster they go, the further they go, rather, above 50, the faster the growth. So we can see in case of France here, we're below 50 and further down. So the pace of contraction accelerating in France. In Germany, we can see we're back to near standstill against expectations of robust growth. So very disappointing there. So too for the region as a whole, 50.8 versus 52.5 expected. To the extent that the ECB president flags this and says this only reinforces our desire to ease this year and boosts our confidence that inflation is going where we want it to go, we again get a growth scare. And of course, we saw that with their cut at the beginning of last month, the ECB top-ticked local markets. That was the major top. Since then, stocks started to fall, echoing this idea that once the cuts arrive, stocks no longer like them. If all of this news flow pointing to global slowdown, coupled with disappointing U.S. economic outcomes vis-a-vis retail sales, come together to give a meaningful recession scare more credibility, risk appetite across markets might well struggle. And we could find ourselves with lower stocks and perhaps even a stronger dollar as the liquidation that comes boosts demand for cash and for liquidity. And that is Macro Money for today. As ever, we are here every week, Monday through Thursday, right after overtime, a show that I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things are headed thereafter. I am on with Victor Jones for the Price of Truth on Wednesdays, back on with Chris for Futures Power Hour on Fridays, on with Victor and Tom for First Call on Sundays, writing for the News and Insights portion of tastylive.com, and opining sporadically on the platform formerly known as Twitter at Ilya Spivak. Thanks very much for joining. Macro Money's back tomorrow.